Hello and welcome to the Premium Account Market Update for May 2017. Any individual reading or listening should discuss with their financial planner or advisor the merits of any recommendation offer presented in this material for their own specific circumstances and realise that not all investments are appropriate for every individual. Presented today, myself, Leon Hine, Managing Director of Investor Signals and a Licensed Securities and Derivatives Advisor. The topics for today, we focus on the macro update driving equities as we roll through the ASX 50 with a focus on FY 18 earnings. We look at the technical trends and we talk about the portfolio allocations and short-term market outlook. If you'd like to know more about the Premium Account service, please contact us. We'd like to work in partnership with you to manage a portfolio of ASX 50 stocks and utilise our derivative overlay to enhance the returns and to protect your capital. Importantly, the assets all remain in your name. Please contact us on 02 phone number on screen or email me directly on at investorsignals.com. Moving straight into the graph of the XJO today, and let's just backtrack on the algorithm engine. So if you haven't, if you don't have access to these graphs, I'll explain at the end of the recording how to register to get a free trial of them. But this is our new algorithm engine that Investor Signals has developed, and just working through it on the XJO index, we can see back here in 2012 we had a buy signal, another one through here in the late part of 2012. These are the sell signals, so if you're long the market, you think about taking profit when these signals occur. Another buy signal here and a sell signal sort of further up the market. Buy signal sort of late 2014. Then the market starts to break down, make some lower lows, lower highs, and we're picking out those sort of structural weaknesses, and then we get a breakout. And the significance of this breakout is, well, I guess we had roughly a 20% plus correction from peak to trough there in 2015, ending mid-2016, and then the higher low formations began, and we had a buy signal there in June 2016 on the low at 5,000 points, and then another buy signal a short while later at around 5,200. Since then, the markets continue to make higher highs and higher lows. Over the recent months, we've exited banking stocks. We exited resources first in the early, really at the beginning of the year, and then in the last month or two, we've exited the banking stocks. We feel that equity valuations are quite stretched, and that'll be a bit of a focus point of today's recording. We're mindful that the XJO hasn't yet really turned into a bearish structure. We still have the higher highs, higher lows, even at a sort of minor level around this point here. But certainly if we were to see this roll over and take out this low, given the high valuations, we would see that as a pretty negative sign for equities. Okay, so we click on the watch list, we would go through, select which watch list we want, ASX top 50, we go back to the charts, use these arrows and start toggling through. There's this button here to add Leon's charts, which will apply all the notations and trend lines to your graph in real time, so whenever I adjust anything, it'll automatically flow through to your graph if you want to turn that feature on. But let's just start moving through the top 50 stocks. AGL, so we think this stock is expensive, and let me give you some numbers on this. It's 23 times earnings on a 3.25% dividend yield. So that's expensive, and we think fair value is probably back somewhere closer to around $22. And what we'll look for over the course of this year is a substantial pullback in AGL and an algorithm buy signal. So if we go back and look at sort of where we've had the signals in the past, we'll be looking for a significant retracement and an algo signal, and the algo engine will automatically email us when that signal occurs, so that comes into your inbox at 3:30, the results of that algo engine analysis each afternoon on the ASX. Aristocrat Leisure, so again, if we look at the algo signals, it's done a great job of picking the uptrend through Aristocrat, but the same thing, the stock's getting expensive up here, and we're looking for a significant structural sell-off and the next algorithm buy signal before we add Aristocrat to portfolios. Amcor, we've continued to hold this. The stock's expensive at the moment, but it's defensive on a reasonable yield. So it trades on a PE of about 19 times earnings on just under a 4% dividend yield. Owning it here, selling tight covered calls, you're getting about 10 to 12% cash flow from the dividends and the franking credits and the option premium while still allowing for some moderate capital growth, but at around $16 we think Amcor is pretty full value but still comfortable keeping that in client portfolios. AMP, we're cautious on this name. We think it's expensive, and the latest trading update out, I think yesterday, sort of showed some of the struggles the company's having retaining funds under management, so that's probably not going to bode well when they've also got those issues with the life insurance side of the business that they had to write off 6 months ago, and there's possibly sort of more issues ahead for the company within that space. So very cautious on AMP at this point in time. ANZ, so we've seen the banks all come out and report. Generally the trend is difficult environment to grow revenue. Loan growth is likely to be subdued due to regulatory intervention. Low wage growth here in Australia restricts loan demand as well. Net interest margins were a little compressed, and then obviously the added tax that's come through from the budget, which could impact earnings up to 5 to 6%. The net result of all that is the elevated price that banks were trading on. You know, we really had a view that there was no further good news left to price into the banks, and we've taken profit on our banking positions, and in some cases we've bought put options in the banks to profit from this down move, and so far those trades have been very lucrative for the accounts that sort of participate in the put side strategies. In the context of where do we think banks are heading, I think you have to form a view that if US equity markets remain stable and China doesn't have any significant headline risks around either property collapses or increased defaulting debt within sort of the wealth management products within China, then maybe the Australian banks at best trade sideways. But equally, a very strong case can be made that they're at the top end of their dividend payout ratio range. They're struggling to grow revenue. We're at record low provisioning of bad debts at this point in the economic cycle. And if you go out 12 months, what's the probability of bad debt starting to increase? There's enough evidence to say that that cycle has turned in America, where we're seeing increasing loan defaults. We're seeing lower demand for mortgages. We're seeing increased loan defaults in in the auto space. We're seeing the banks having to restrict lending standards in that regard. Credit card defaults, consumer loan defaults. So to me, we're probably in the very early stages of that cycle already turning, which would suggest that greater risks lie ahead for the Australian banks. So I think still need to remain cautious there. But ultimately, we may see a technical bounce here, but we would look to sell that, is our view on the Australian banks. To put some specific numbers on ANZ, where things sit at the moment, the stock's trading at about 12.5 times earnings on a 5.5% yield, and if we go out over the next 12 months, we don't see any change to the dividend, and we don't see any scope for an uptick in earnings. APA Group not doing there at present. ASX, I think this is a very defensive business. I've chatted about this, but it's expensive. 23 times earnings on less than a 4% dividend yield, and recent data from the ASX suggests that again maybe 1 to 3% earnings growth would be a good outcome over the next 12 months. Horizon Holdings, so we had an algo buy signal here at 425. We're at the top end of this range. I think the stock's expensive. 23 times earnings, 4%, 4.25% dividend yield, and as I've spoken about in the past, I think there's a chance that the company has to cut its dividend in the next 6 months. So whilst the algo signal did a great job of triggering that buy there, we're not continuing to hold the stock. We'll wait for the next higher low formation and the next buy signal to consider entering AZJ. BHP, so here I've overlaid a using Elliott wave, just a wave count, and really what I wanted to highlight here is the rally that BHP's had in 2016. We're roughly sitting not quite back at 50% retracement. So I put a post on the blog highlighting that fair value for BHP is probably somewhere between around $21 and around $22.50. We're looking for a small technical bounce, but I think ultimately it runs into resistance again up at around $25. But maybe there's a short-term momentum play there in BHP with stop losses under $22.50. But if we see sort of longer term back down at $20.50, could provide a more substantial base for BHP to trade higher. Brambles, we like this. We've been buying it off the low here, and we've now started to take profit. The stock's back on 20 times earnings and a 3% dividend yield. Forward earnings growth around 4%. You would assume that the stock's pretty full value here, and you either take profit on it, or if you own it, sell covered calls and boost that cash flow. CBA, so again, this is the analysis for the banks is obviously all very similar. They're struggling to grow revenue, net interest margins are compressing a little, and the imposed tax from the budget's going to weigh on earnings by about 4 to 5%, and that's in a backdrop when they're already struggling to grow earnings at any meaningful level. So base case is they move sideways, or I should say sort of best case I think is that they consolidate and move sideways, but you've got those structural issues with where we sit in the bad debt cycle, I think, that you need to think about as far as allocations to the banks. Computershare, this stock had been making lower lows and lower highs, and then it's had a breakout from around $11. Extraordinary strong move here, which is partly because the Aussie dollar's pulled back, partly US interest rates went higher. But for me, I find Computershare very expensive at 21 times earnings and a 2.4% dividend yield. And I think the market's optimistic about what forward earnings look like. So to me, Computershare's a shorting opportunity at these levels. CSL, we continue to like this name, albeit very expensive, roughly 28 to 30 times earnings, 1.5% dividend yield, but strong underlying earnings growth at 20% per annum earnings. But you would think that it sort of struggles to move too much higher from where we are. So if we go back and look at the algo engine, gave us a buy signal here at around $100. Prior buy signals back in 2015. No sell signal at this stage, but probably reluctant to buy into the rally at this point. Again, we'd look for sort of the next structural low and the next algorithm signal as an entry point on that. Caltex, we like this name. We actually bought this at around this sort of $28 level. We see full value now up here at around $23. The stock's trading at about 15 times earnings on a 3.5% yield, and the algo engine's just sort of flagging that we've sort of got this structural lower high pattern starting to emerge. I think that's enough reason to probably look to take profit on that trade. Fortescue, we had a sell signal up here and the stock's collapsed, and we've now had a buy signal. Look, I'm steering clear of the iron ore plays. Rio's on the radar. BHP's one that we are trading, but not really sort of doing too much there right at the moment. And I'll sort of flag the stocks that we are, and obviously Amcor was one of those, and I'll sort of emphasise the next names that we're active in as we move through the recording. GPT, we've been holding this and either just starting to take profit now or selling covered calls. We're pretty comfortable with the strength in the office market in Sydney and Melbourne that's helping to underpin GPT. We don't see interest rates moving higher, but the stock's close to full value. So it's a story of either locking in profit or selling an at-the-money call and boosting that cash flow up to 10% plus per annum. Insurance Australia Group, this is another name that we've been active in. The stock had sort of been making lower lows, lower highs, but as it started to break out here and form a base at around 575, we've been buyers of it. And again, we've now either taken profit or sold covered calls over IAG. Don't see it doing too much more beyond here. Trades 19 times earnings on a 4% dividend yield. But it's interesting, when money came out of the banking stocks over the last week, we've seen it flow into the insurance names. So IAG, QBE have done well as examples. Incitec Pivot delivered an okay earnings result, roughly around 18 times earnings on a 3% dividend yield. I think keep this one on the radar, look for it to consolidate. We're not doing anything there yet, but it's certainly a stock that's on our radar. James Hardie, we think this is expensive at 28 times earnings and 2.4% dividend yield. So whilst we have owned that in the past, we're not holding it currently. Lendlease, again, we think this is getting expensive. 3.8% dividend yield, roughly 10% underlying earnings growth, but we're avoiding sort of these stocks with exposure to the sort of development area in the property market. Medibank Private, so this is a stock that we hold in portfolio. So I've spoken about Amcor. Medibank Private's been one of our core holdings, but again up here at $3 the stock's now expensive, so it's a time to take profit or sell at the money. Covered calls at 19 times earnings and less than a 4% dividend yield, and the probability of not too much in the way of earnings growth, we think this is full value. We'd certainly be buyers of it on a pullback on the next algorithm entry signal there. Macquarie Bank, so the last algo buy signal was here at around $82, pushing a little higher. Macquarie's profit result came in a little bit above expectations, a little bit above $2.2 billion, whereas if we go back prior 12 months, it was roughly $2.1 billion. Again, we're given our overall sort of cautiousness around the valuation of equity markets, though, we're really looking to see whether the XJO sort of rolls over and creates that lower high structure, and then obviously that'll have implications for Macquarie as well. National, we've seen this start to roll over, as have the other banking names, for all the same reasons. We last had an algo buy signal there at around $24. The stock's performed well, but we don't see it doing any further from where we are at the moment. Newcrest, we've been buyers of this in the last few days. Now we've set this trade up just through buying call options into July at the $20 strike, which is giving us great leverage to a rebound here in Newcrest. And obviously what our thinking there is that gold will find support at around this 1,220 an ounce and maybe trade up to 1,300 US an ounce. Newcrest should recover back up to sort of 22 to maybe as high as $24 in that environment. Origin Energy, so this has been one of our preferred energy plays. I put a post on the blog this morning regarding Origin. It's making higher highs, higher lows, but at $8 the stock's full value, and we've taken profit there. What we are looking at doing is rotating out of Origin and into the oil ETF, which I'll chat about in a moment. So let's just keep moving through these names. Orica, not doing anything here at the moment, but worth flagging. The algorithm engine gave a buy signal at $17.50, and the stock's certainly pushing higher. So the way we'd approach that is buying it off the back of this higher low formation with a stop loss below. Will probably prove to be a fairly prudent trade there. So we'll continue to watch Orica as that momentum pushes higher. Oil Search, so you can see the structure here, looks to me to be beginning to sort of break out of this downtrend and starting to make higher highs and a higher low. So happy to give this the benefit of the doubt of it trading higher with a stop loss below sort of that $7 range. Qantas, terrific breakout here in Qantas. The earnings result turned out to be much better than I'd expected. To have a look at sort of a valuation here, the stock's probably pushing up to about 3.5% dividend yield, but again, we're not chasing it at these levels. We'll look for a structural sort of pullback in the next algorithm buy signal, where we've had sort of similar situations in the past where the stock's rallied, pulled back, and the algorithm engines flagged the buy signal. So we'll look for something similar throughout this year as an entry point into Qantas. But if anything for us at the moment, we're probably looking at Qantas from the short side, not so much from the long side. QBE, so we've had this consolidation here and the stock's breaking out. For us, we think sort of QBE's probably close to full value. We have been recent buyers of it sort of through this consolidation range, but now we start to look at either take profit or selling calls up at around $14. The stock's on about 15 times earnings and roughly a 4.4% dividend yield. But the company does seem to have a bit of positive momentum in its favour at the moment. Ramsay Healthcare, so we'd been buyers of this on the dip. and I'd made comment on the blog about that, but again, we're taking profit. We see the market clearly at full value, so any opportunity now to lock in profit just seems to be prudent and keep a high cash reserve and have some exposure to that long gold position, some exposure to a retracement in the XJO. In the case of Rio, we've seen the stock correct from $70 down to $60. We think that iron ore prices remain under pressure, so this small technical bounce might be short-lived in these resource names. South 32, we had an algo buy signal here at $2.40, pushed up to $3. Centre Group, we actually don't mind this name just from a cash contributor to portfolio. So owning it at these levels, collecting a 5% dividend yield and selling a fairly tight covered call generates about 10 to 12% cash flow. And we actually see the stock mostly moving sideways and holding up okay in a down market. Stocklands, we're concerned this is looking a little expensive up here. To put some numbers on Sonic on Stocklands, it's about 15 times earnings on a 5% dividend yield. Has got a higher high, higher low structure, so it's not really until the price started to break down and then find resistance on the way back up that we would be attracted to actually setting up a position over Stocklands. But it's not a stock that we hold. Sonic, on the other hand, this is a core holding in our portfolio. So going through a few of the key names, we've looked at Amcor, we've looked at Medibank Private, we've looked at a couple of shorter term trades that we've made with Origin and Caltex. Sonic is something that we hold longer term, so we see this as a core portfolio holding. We own it at lower levels. We've sold covered calls out to December at $24, so we're locking in the opportunity for good capital gain, plus we're getting 10 to 12% cash flow from the dividend and the call options. But for us, Sonic at this level is close to full value, which is why we've sold the covered calls at $24. And to put some numbers on that, it's about 21 times earnings on about a 3.5% dividend yield, but should grow earnings about 8%. Santos, not doing there at the moment. Suncorp, we think this is expensive and an opportunity to lock in profit at these levels. Sydney Airports, we own this name, so Sydney and Transurban have been other core holdings in our portfolio. We own this at lower levels, but now it's full value. So the stock's trading on less than roughly a 4.25% dividend yield, either taking profit or going out on the other side of the June dividend and selling call options in September at around $7.25. Again, boost that cash flow to over 10% per annum, and we think sort of Sydney Airports really just consolidates where at the current prices. Same with Transurban, we own it at lower levels. We've either taken profit or we've gone out to September and sold the 12.25 covered calls, again turning a 4% yield into a 10 to 12% cash flow. We think that Transurban's pretty much fully valued. Telstra, with a stock on a 7% yield, assuming 31 cents of dividends, what analysts are now saying is that we can expect the company to downgrade their dividend payout from 31 to 25 cents, which puts the stock back on about a 5% dividend yield at its current prices. There's no evidence as to when the company's going to do that, so it's only speculation around the timing, but the market's certainly pricing Telstra now on the basis that within the next 12 months the company will reduce that annual dividend down to 25 cents. All things being equal, it appear that fair value for Telstra is maybe somewhere between 440 and 480 as a new trading range. Treasury Wines, this is a stock that we've just recently bought and we've taken profit very quickly on this. So we saw the positive momentum that Treasury was enjoying. It's obviously growing earnings at one of the higher growth rates within the top 50 stocks. But we now see it as sort of from a risk-reward point of view where we've taken the profit, and if we see a pullback, we'll take another look at it. The algo engine's done a great job throughout this rally of sort of helping to identify the higher low formations to keep exposure to Treasury Wines. Westpac. So interesting that we've just got, so on a number of the banks we've had the algo engine flag a buy signal, which is really a result of sort of the sell-off and volume building. On the blog, the way we've described approaching this is, I think investors, and I'll just zoom out on the chart so we can take a closer look at this. I think you could say it's okay to set up a long position in the banks with a stop loss below this point here, but my expectation is the banks actually don't recover much more at all than 50% of this sell-off. So in the case of Westpac, you'd expect on the upside a maximum of $34, I think, before it runs into resistance. And I think in all likelihood the next leg down will actually take out this low and maybe see Westpac consolidate back down at around $31. But in the short term, I think you could see that push higher up to around $34. So hopefully that sort of strategy, and I think that can be applied to all the banking names to give you an idea of the way we're viewing things. Wesfarmers, I think this is now expensive. We own it at lower levels. We've been aggressive selling covered calls up here at around $44. They expire at the end of this month. We've collected good premium for those. So whilst this stock's been moving sideways, instead of just getting a 4 or 5% dividend yield, we've been collecting 10 to 12% cash flow off Wesfarmers. Westfield, we don't mind this name, but obviously recognise the risks that retail shopping space is having globally. So therefore we're seeing limited earnings growth in Westfield, but owning it here, selling tight covered calls, getting 10 to 12% cash flow. So we've been pretty aggressive and we've sold calls at the $9 strike, and we did that some time back. So again, we're getting over 12% cash flow per annum, and our view is that Westfield mostly just trades sideways around that $9 price point. Woolworths, so we've been buyers of this stock. We recognised that it's broken out of that down structure, created higher highs, higher lows. Our target's $28 on this. We've gone out to December, sold the $28 calls. We're expecting to keep exposure to the September dividend. The yield on the stock is low. It's only around 3%. So even with earnings growing moderately, we don't think the stock would have the capacity to trade too much above that $28 strike. So again, the dividend, the call option, we're getting 10-12% cash flow, plus we've enjoyed the capital growth along the way here. Woodside Petroleum, not doing there at present. And there we are, back to the index. So let's just zoom in and have a look at what our short-term analysis of the market is. And it's really centered on the fact that, yes, the market's making higher highs, higher lows. We're concerned about the Dow Jones and the valuation of US equities. When we roll through the top 50 stocks or even the top 100 stocks, you know, there's a number of companies that are trading anywhere from 21 to 28 times earnings on 1.5%, 2.5% dividend yields. We think that's overly optimistic, and the chances of a sort of sharp correction to the downside are very high within equity markets. So we've been very defensive with the type of names that we're holding in portfolios, and we're using inverse ETFs and options to try to profit from down moves in the market. And a real signal to keep an eye on will be if you see the index break below these recent lows. I think that'll start to sort of emphasize some of the weakness that the market's now starting to have to deal with. Thank you for listening in. If you'd like to know more about the Investor Signal service or have a chat with me about working in partnership to manage a broking account, please give me a call or email me using the details on screen.